Hi, I'm Dr. Raghu Anand. I head the Value Addition Department at CMS Jain University, and I'm here to give you an introduction to a very important concept in accounting, which is called the classification of accounts. So I'll take you through. So now let's try to understand. See, we already know that accountancy basically refers to recording all the financial transactions. In one word, to understand the meaning of accounting, accounting is nothing but the record of the financial transactions. So what it basically means is, as and when a trader has a transactions in the business, he will start creating accounts for it. For example, he has a cash transaction. Say he gets cash or he gives away cash or whatever. He will have an account what is called as the cash account. Or say for example, he buys goods in his business. So he will have an account what is called as the purchases account. Or say he makes some sales in the business to get the revenue. He will have an account called as the sales account, etc. So at the end of the period, you will find that the trader will have innumerable accounts with him. And now these accounts should be entered in the books of accounts. All right. So it has to be entered on the basis of double entry. And if we have to do that, then we need to understand how accounts are getting classified, which is what is called as classification of accounts. The first step in accounting is to learn the classification of accounts. There are two approaches to it. One is called the traditional approach, one is called the modern approach. And I think I'll first take you through the traditional approach, we'll understand it, and then proceed to the modern approach. Let's look at the classification of accounts. First, I'll take you through the traditional approach. This is what we've been doing quite some time now. Traditionally, if you look at it, as I already told you that you'll have a lot of accounts with you. You may have a cash account, purchase account, sales account. You will buy and give it back, what we say purchase returns, or you will sell and get it back from the customer, what we say sales returns, etc. So when you have a lot of accounts with you, you need to classify them, categorize them, put all the like accounts together. So what we are supposed to do in traditional approach is that we have, let us say I have about say 10,000 accounts in my business for a certain period of time. I still will be able to classify them only under three heads. First is called the personal account, then we call it as a real account, and finally we have something called the nominal account. When you say personal account, as the name itself says, the first example of a personal account is the account of human being. All of you have a name. So you write an account next to your name, automatically it falls under personal account. For example, my name is Raghu Anand. So I say Raghu Anand's account, automatically Raghu Anand's account is not nominal, it is not real, it has to be personal account, it's an account of human being. Another example of personal account is the companies and institutions. For example, if I say Jain University account, or I say Canara Bank account, or I say Wipro Limited account or something like that. So all the companies, institutions, schools, colleges, everything comes under personal account. The reason is there is a person who is representing this. You talk about a college or a university or an institute or a company, you will find a secretary, you will find a principal, you will find a chairman, you will find somebody who is representing it. So companies and institutions come under personal account. Association of persons also comes under personal account, almost similar to the second point. For example, we talk about something like say Jayanagar Sports Club. Jayanagar Sports Club is a classic example of association of people. They also fall under the personal account. And then we have one more account which is called the representative personal account, which I'll come to it a little later. So once we know that first category of accounts is personal account, then we can move to the real account. Real account is about all the assets in the business, right? When I say assets, for example, let us say we have cash, okay, or say something like plant and machinery, or you have something like say land and building. Now all this comes under the category, we call them as the assets. These are the things which are owned by the business, which has a value, which helps in the smooth functioning of a business. So plant, machinery, land, building, furniture, motor vehicles, all these are assets, and all assets comes under the real account category. And ultimately we have something called nominal account, because the moment we say business, we are talking about receiving some benefit, we are talking about giving some benefit. So I'm talking about all the incomes over here and all the expenses over here, right? So we can broadly classify them as personal, real and nominal. And then there is also a category in personal account which I already told you called the representative personal account. There's a very thin line of difference between representative personal account and the expenses account. For example, if I say salary account, okay, which is a very important expense for any organization, right? So they're giving salaries to the employees. When I say salary account, it comes under nominal account. But if I say salary outstanding account, okay, automatically it comes under the category of personal account. I'm sure all of us understand the difference. When do I call something as an expense? When do I call something as a liability? Now, expense is the employee has put in his service, the organization has paid the money to him as salary. So, the benefit has passed in simultaneous direction, opposite direction. So, which means this is an expense. The moment it is an expense, I say salary becomes nominal. Now, salary outstanding means the employee has put in the service, but the organization has not yet made the payment. If you can look at the arrow marks here, you have two arrow marks going in the reverse direction, opposite direction. So, which means that I have received the benefit, I have given the benefit, an exchange has taken place. This is an expense, and expense comes in nominal. Whereas here exchange has not yet taken place, it becomes personal. The moment I say salary is payable, the question is to whom is the salary payable? And I say salary is payable to the employee. So, what happens is employee is a human being and his account automatically comes under personal account. So, we need to basically, in traditional classification, we take all the accounts, innumerable accounts, when we start grouping them, dividing them as like-minded accounts, we find them as personal account, we find them as real account and nominal account. Yeah. So, when we look at the modern approach, we have already learned that in traditional approach there are three categories, we call them as personal, real and nominal. But in modern approach, what happens is, the bifurcation is a little different. Though it covers the entire thing, whatever we have seen in the traditional, but still, there's little bit of difference. In modern approach, we talk about three different sectors. First division is, we talk about the owner. Owner is the person who has taken the risk and who has invested the money in the business. All right. So, we talk about the owner. We talk about something called the financial position. We also talk about the actual business that he plans to do. So, first thing, when I talk about the modern approach for classification of accounts, when I say owner, I talk about two accounts over there. The first account is the capital. Now, what is this capital? It is the investment whatever the owner has made in the business. So, the entire capital related details is going to be recorded in the capital account. And when you look at the drawings, okay, drawings is nothing but the benefits the owner has taken away from his business. Now, let us say for example, I have a business, all right, and say for example, I am running a hotel and I am hungry. So, what I do is I will say consume something in my hotel, I will eat a plate of masala dosa or something like that, for which I do not pay money back to my business. So, which means it amounts to something called as drawing. So, taking away something from the business for own use, for personal use, for domestic use, we call that as the drawings. So, we will try to keep a track of the owner's activity in the business from two perspectives. One, we try to know what is the capital, what are all the investments that he is making, like the initial capital, additional capital, etc. And second, we also will try to keep a watch, we also will try to keep a tab on the drawings that he is making from the business. And very obviously, if I ask you what should be more in a business, anybody would say capital investment should be higher in a business. As far as possible, you should try to keep drawings under control, because the more and more you start drawing, your capital will start depleting. So, first aspect in modern approach, like how we have personal, real, etc. First aspect is from the owner's perspective. So, from owner's perspective, we have a capital account and we have a drawings account. Then we look at any business from its financial position perspective. Now, what is a financial position? Financial position is where you have certain assets with you, you have certain liabilities with you. You are expected to be having a greater amount of assets as compared to liability. That is when we say you have a solvent business, which you are running. So, we try to keep a track of all the assets. If you can recall, in the traditional classification, all the assets would fall under something called real account. But here, all the assets are falling under something called as the assets account. All the liabilities refers to anything which we are supposed to pay, like the amount of money I should pay to my suppliers, the amount of money I should pay to my people who have supplied goods, etc., to me, the creditors, etc. So, all the assets and liabilities will be recorded, and these two put together, we can say it is a reflection of the financial position of the business. The third perspective is the actual business itself. Whenever we are doing a business, we know that we will have something what is called as a revenue or an income. We also know something what is called as a expense. And obviously, common sense tells me that revenue should be greater than my expenses, only then will I get something called as a profit. Otherwise, I may not get a profit, right? So, and if of course, all of us also common sense will tell us that expenses, when it exceeds the revenue, it results in a loss. By chance, if these two are equal, it will give us something called as a break even, all right? But generally, a trader wishes that the revenues are higher than the expenses. So, under traditional, when we say it is real, it's personal, real and nominal, three categories. Under modern also we can say three categories, one from the owner's perspective, one from the financial position perspective, and from the business perspective. So, once we are able to decide as to under what category can I fit in a particular account, then recording that under double entry becomes easy. If we can look at certain differences, let's say for example, capital account. Now, in modern approach, I say capital account comes under the owner's account category, but in traditional approach, I say capital account comes under the personal account category because it's the account of the human being. Or say for example, something like cash account. Cash account under traditional approach comes in real, but cash account under modern approach comes under the financial position or the assets account, right? So, all the income, expenses, everything is taken care of in this particular thing. So, both traditional approach and modern approach almost are the same. The way we look at it is what differs. So, the moment we are able to categorize them under traditional or under the modern approach, we have groups of accounts with us. Now, what we do is we take each group of accounts and start actually recording that in the books of accounts, because we know accountancy basically refers to the record of the transactions.